Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Friday, August 29th, 2025. It's 9:47 a.m. Eastern Time as I'm starting the video. Just want to get an early one out to you guys and note a few things. I fired off that SMCI trade setup, a trade idea, actionable trade. It's a breakdown. I'll get to that one second. Also wanted to mention QQQ broke down that minor uptrend line I had, so we're still good here. Stop was placed right about where I think it should have been. And so far, that most recent, these are just again short-term swing targets. I've covered this quite a bit, so if you have any questions, just click on QQQ at the bottom of this post once you read it, and it'll load up all posts covering QQQ in order of most recent, so you can check those out. But either way, that's it. So take it, don't take it, up to you. I'm going to go over a couple other things that I'm watching today and the reason I'm doing this video early. So that's it. So there it is. Pretty impulsive so far. We'll see if it sticks. The day is early, very early right now. Again, we're, as I speak, only 18 minutes into the trading day, so anything can happen. Wouldn't be the first time to see a whipsaw signal. What I mean by that is, ideally, you want to see if you're trading a 60-minute time frame or any time frame you're trading on. It confirms, if you will, the breakout or breakdown if you get a closing candlestick of that time frame. In other words, this is a 60-minute chart. Now, there are 6.5 hours in a trading day. So the first candle they give you is only really a half candle. It's a 30-minute candle from 9:30 to 10. Then they roll hourly on the hour the candles are finalized. So, but I like it. I like it based on, remember, we've had recent sell signals, which I've continued to reiterate. The market, you know, on the big ones that I think are most important, that I know, not think, it's a fact. The stocks that are most important in the market: NVIDIA, Microsoft, Apple, Amazon, Google. Like I said, the 500 stocks in the S&P 500, the 490 lowest can go wherever they want. You have such a high weighting on the top 10, and especially with the Nasdaq 100, they dictate where the stock market goes. Again, that's a mathematical fact, not an opinion. All right, and then again, there's the psychological impact too. So. All right, that's it. Let's not harp on it. Take it, leave it. It's certainly an objective add-on if you're already short, a new short entry. If you're bullish, I've said this many times, if you are on the camp that the market's going to just keep going up this year, well, any or all of my price targets where I'm looking to either, you know, on a break, if I want to add some more shorts on any accounts that I have, would wait for a breakdown of those. You could take it in reverse and use those same support levels, which are, I believe, technically significant, to step in and buy. So maybe you are of the mindset, well, we're a little frothy, we need a correction, and then the market's going to go to new highs. T2 right now is a big level for me where if taken out, I think it's going to increase the odds we go there. But you could also go long there if that's your preference. All right, let's move away from that. I'm going to tell you what I think is going to happen. But most importantly, none of that's ever guaranteed, as you very well know. And like I say, my skill sets usually lie in identifying significant key support and resistance levels, trend lines, developments in the market that are likely to that matter. In other words, like I just said, a break of support typically ushers in selling, and that's where a long might want to have their stop somewhat below if you're long on a position. Whereas if I'm bullish, I'll look to buy a pullback to support. So let's just jump into SMCI. Started with that one today. Okay, the day again is very, very, very young right now. We are not even half hour into the trading day. So this could very well become a whipsaw. What's a whipsaw for those of you new to the site or new to trading? You go down through a candlestick consists of three parts. They have a fat part called the body, just let's not worry about the color right now. And then you have these two skinny parts called the shadows. When the shadow's on the bottom, like I'm drawing here, that's called a tail. When it's above, they refer to the shadow as a wick, just like a candle. So there's your candlestick body right there, shadow wick. So, you know, right now we're clearly below, but if this candle by 4 p.m. today goes like this, and let's say this body right here, we close up here, and there's the close right there. Then you close back above there, and what it's going to look like, you're going to see just a tail hanging down below, and that's what we call an intraday break. But as I've talked about, more goes into it than just that. Let me pull that trend line back like I showed. There's the trend line. So there was a lot of moving parts to this, and I've been covering this one quite a bit recently. You had a very well-defined downtrend line off the highs on SMCI, and again, I'm just repeating what I've covered quite a bit recently. And we had a breakout that failed. We put in a divergent high, negative divergence, and then that breakout came back into the wedge. So this whole thing there was a failed, aka false breakout, and that is very bearish from my experience. When that happens, you go back, once you go back into the wedge, once a breakout has failed, you're typically going to go down through the downside of it. That's again from my experience, and I just always tell you the same thing. I trade in probabilities, not possibilities. Anything is possible. So when I look at probabilities, is it above 50%? Is it well above 50%? You know, that gauges my confidence, and that's it. So it either works or it doesn't. This market's been, you know, full of whipsaws, especially on the short side when you're in a bull trend, and the opposite thing tends to happen in reverse in a bear trend. So, all right, that's it. New price targets for you, including a suggested stop, which is tactically placed. If we go through here, then we've had a bunch of whipsaws, and this triangle doesn't mean much anyways. Plus, you're past the apex. You're getting to the apex of the triangle. So, and again, I frame every trade. It's, you know, I look at the RR. When you short in a bull market, especially when you short a tech stock, especially when you short an AI stock in this market. This is today, AI equals .com in 1998, 1999. Same exact thing. So anything related, especially, this is what I call Robin, or the Batman and Robin duo, NVDA and SMCI. It's a little sidekick. It's going to move that. So when you're shorting an AI stock in a bull trend, that is very much a counter trend trade. So by that definition, if we want to call a spade, I'm going to tell you that the probability of success is lower than it would normally be, right? When you short a stock in a bear market, you have a higher probability of success. When you're shorting in a bull trend, it's harder. Your success rate's lower. However, everything that I do is kind of weighed out with two factors: the probability of success that my convictions on how likely that trade is to play out, coupled with the RR, the risk reward. So on this one, you're risking about, short the breakdown, you're risking about 15%, right from where it broke down today. If you took that, was highlighted in yesterday's video, 16%, whatever you want to call it there. And we're going to go down, and if hit, it's going to be about to the final target, about a 60% downside. Okay, so right there, you're looking at about a, what is that, 4 to 1, 4 to 1 RR. I'll take that all day long. All right, and now you may say, yeah, okay, well, that's a crazy target. Well, if you don't, if you're only targeting T1, which is a quick, 10, 8, 9, 10%, 11% to the T1, it's a zone I have, then you're going to obviously want to use a smaller stop, maybe a re-entry back in there. Maybe there's a little gap right there if it wants to kick back right now. People love backfilling these gaps, traders, and then you have a reaction high there. These are all your overhead resistance levels. I don't want to talk on it much more. I like it. I want to say I very much like this trade. I like the last one. Last one, they just clipped that suggested stop I gave you, but then it went on to that stop was placed, in hindsight, a little tight. But we've had a lot more wins than losses on this one. Some really big gains, high double-digit gains on this one in the last couple of years. Again, very much like it. And by the way, I wanted to do the video because this morning after the open, I had a flurry of price alerts go off. I had XRT, which is still waiting to crack. It is cracking. It triggered because it went below that trend line. But this is why I set those alerts. I always check. I come in, I tighten up my trend lines. I want to touch the bottom of that one. I'm going to pull this right here, and I don't know if this trend line will reset automatically. Sometimes they do. I'm going to set it again. So this is one to watch, and that's why, the benefit of being in front of the computer when you have an alert, you can look at it, make sure, okay, is that one that's ready to go? Needs a little bit more nudge. And we need that candle to come down here and either, clearly get down below there or print a solid close below there. And that's a beautiful bearish rising wedge. It's a trade idea that I've given you recently. I gave you 5 targets. And again, the Downside target to that one's about 34%. That's XRT, the retail sector ETF. So guys, I've been pouring over the charts last couple of days. I know this market looks like it's never going to stop going up. I'm going to read something, a reply. Someone asked about corporate buybacks today. I have a response I made to that I'm going to share with you. But I just wanted to get this out, this post, because I have quite a few alerts firing off today, including this one as well. I believe this was also covered in yesterday's video along with SMCI. S1's been taken out. Somebody brought this up. Yeah, I replied to them yesterday. They might have brought up the day before when I was out. And that's it. So we've now taken out S1. That's an objective short entry add-on there. Plenty of meat left on the bone. If this one plays out, about another almost 30% downside left in EURBN, Urban Outfitters. And what else did I have? Oh, I had NVIDIA fire an alert today. I must have in yesterday's video. I think yeah, I did. I gave you a trend line right there. This one, the uptrend line off the lows right there. And that's taken out. And believe me, that very much went into the fact I fired off SMCI as a new official short trade. Those are the ones I, tend to have the highest degree of confidence in. 90+% of the trade ideas I give you are in videos. And sometimes I'll have a very high confidence on a trade I give you in a video. I just don't have time to mark up the charts, get it out. So I'll cover something over again in a video. But I just wanted to say that, yeah, SMCI, as I've told you many times, and tends to follow NVIDIA, especially when NVIDIA is correcting. SMCI can sometimes do its own thing when it gets ahead of itself in a bull trend when NVIDIA is trending up. But when NVIDIA starts to correct, those two are just kind of locked together. It's just almost a paired trade, if you will. You're just going to get more bang for your buck on SMCI. The analogy I would use is like trading gold and GDX. You've heard me say this often. Now, typically, for tax purposes, I'll usually trade futures, either gold or silver futures. I wish GDX had a futures contract. I don't believe they do one on a sector like that. Some sectors do indexes, but the reason is if gold goes down, GDX is going to go down in a multiple thereof, especially in the bigger trends. Not often day to day, but always in a larger trend. If gold corrects 20%, GDX is going to drop 40. Let's say it's not always a 2-to-1 multiple, but it's close to that. And likewise, when gold rallies and goes up 30%, you can expect the miners to go 50, 60 or more. And then same thing with NVIDIA and SMCI. So it's a case of kind of either getting it right or getting it wrong, and then getting paid on it. You're going to get paid more shorting NVIDIA. Look, you even had, this is what I call a wedge overthrow. It was still divergence right there, but when you have a bearish rising wedge like that, something I kind of came up with years. I haven't talked about it much lately. Used to see a lot of it in 2007, towards the end there, 2008, where you get these in a strong market. You have a bearish rising wedge and you get a wedge overshoot. Kind of like that triangle overshoot SMCI did, or breakout. You overshoot and then you come back down in the wedge and then down below. So either way, that was, if you want to just draw the lines that way, you still had a divergent eye on the SMCI 60. Okay, enough on that one. It's one trade. It either plays out or it doesn't. You don't put all your money in any one trade. You spread your bets. What else do I have for you? Those are the alerts today. Let me just check. Let me pause the video and check my alerts that I've had the rest of the week. That Ruger I gave you is the only other one. That was about, when did I have that on? 8/22, so that was last week. It popped R2, but not on a close. You can see, or didn't really take it out and then got rejected. But it still broke above the downtrend line, so we need to take out now. And the way this works, so is when you have a resistance level like I had there, and you pop it, but you fail to close above it, solid close. Now you have established a reaction high. So that's really the new level you want to see get taken out. Not so much the 34.95 now. I just want to point that out. That's still the resistance level, more reactions along that line, but that's where that is. Since I mentioned gold, I don't know if I covered this in a video the other day. Somebody asked me gold and silver, and I said there's no change. We've been in a trading range literally since the beginning or early mid-April right there. And so, until gold breaks one way or the other. And then the reply that I made in the comment section this week was that if we break out anytime soon, it'll still very much be, again, if it happens soon, a divergent high. So it's a breakout that will most likely fail. And then again, I've said this often, there are no guarantees, but breakouts that occur with negative divergence and overbought conditions have a much, much higher rate of failure than breakouts that don't have those conditions. So we'll see. In other words, translation is, I would watch, I wouldn't chase. I don't have a position. This is dead money. This is a dead money trade right now. And surprisingly, dollar's up a little today. And gold and silver are moving up. But again, in a trading range, it's all noise to me until we have a definitive break out of there. And again, if it's a downside break, that's when I might short. Well, I'll tell you at the time. Guys, there's no reason to be in gold right now, in my opinion. And then the miners and silver are going to follow it to a greater or larger extent. But I showed you the king of everything. And it's funny, some buffoon wrote an article yesterday that we don't need NVIDIA anymore because, NVIDIA went down after earnings, went down a little bit, and saying, I didn't read, I just looked at the headline that NVIDIA doesn't matter anymore. NVIDIA still very, very much matters for the reasons I said before. Number one, it's the largest component of the S&P 500 and Nasdaq 100 by far. 8% of the S&P. The S&P is 500 stocks. It's even larger than the Nasdaq 100. And then it's a psychological impact. It's the king of AI. It's like literally, it's the pets.com. The pets.com became the poster child for the dot-com bubble afterwards because it was one of the first ones to go bust. So if you were around back then, pets.com was kind of the poster child and after the fact. But we all know that NVIDIA is the king of AI. And I just wanted to get to you that, if that's, and it's like I said, it's broken down today. I gave you a sell signal on NVIDIA. So if you've been waiting for a decent sell, we already had sell signals in the market. We're already short the market. Now it's a reason to add to those positions. NVIDIA earnings are out of the way, so you don't have that big gamble and risk. This is the VIX, the VIX itself, the spot in VIX. Still that big divergence and this whole uptrend line right here. The VIX has been moving up, which is typically what you'll see with the market making new highs recently and the VIX still making higher lows. That's usually a precursor to a much bigger move. So I have not changed, waffled, or removed my third target. This is a in and out trade. We've had several, we traded the VIX long back here, hit my final target there. We did it again here. We hit my second target, expected a pullback. We've gone lower than I thought we'd go. And remember, VIXY, like all these VIX tracking ETFs, it suffers from decay. It's just like somebody asked yesterday about BOIL. Should I be in BOIL instead of UNG? I said I wouldn't unless you're really, really confident that UNG is going to go on a unidirectional rip, meaning almost all green days, and there's a explanation I put in the FAQ page on right side of the chart that explains that math. And so right now, as much as I like and I'm long nat gas, there's some work to be done before I have that highest degree of confidence we're going to go up in that, again, mostly straight up unidirectional rip. Anything against it, the decay works against you. So that's why you're going to see over time, and I say this often, these are hit and run instruments. So now that you have NVIDIA breaking down today, and again, NVIDIA being, in my opinion, the stock market, yeah, there's a case to step in. This is just a daily chart, and that target is and still is subject to change based on the spot VIX due to the decay in VIXY. But again, I wanted to say that VIXY is making a new low, but the spot VIX isn't. In fact, the spot VIX is at that trend line. Here's what VIXY looks like. So we had a downtrend line. We broke it. We've just been back testing it for what seems like forever and a day, but it's really only been the last month. And so with NVIDIA breaking down, if it takes the rest of the lot down with it, I suspect it will, meaning the other Mag 10 stocks, the market, then you've got a lot of juice here. And look, now the RR is very good because you have, again, spot VIX. This is spot VIX 60-minute chart. Big, nice, clean, positive divergence. We've been long and almost, I believe, all these divergent lows recently. These are all double-digit, even triple-digit pops, guys, on the VIX. And so a lot of meat on the bone because this market is just not pricing in the risk. There's a nice near-term target if you're interested. 22 on the spot VIX. You have all these recent reaction highs. Those are the most important. I always put a higher weighting on the most recent reactions. That's about almost a 60% run right there in the VIX if you get there. And before I get the comments, I get them all the time. I don't mind, guys. I've been doing this a long time. That's what you pay for. You can ask me about it, but any of these VIX tracking instruments aren't going to mirror what the spot VIX does. So a lot of times you're going to see the VIX up 10, 20, 30% a day or whatever it is, 15%. You're going to wonder why VIXY is only up 8. It's not the VIX. It's a derivative. It's what we call it. It's an ETF that buys but has a lot of expenses, buys futures, and it also is buying the short-term futures. You, me, anyone, even the most largest hedge fund or pension fund in the world can't buy the VIX. It's not buyable. It's a theoretical spot index. You can only buy derivatives that track the VIX, and those derivatives are based off the futures. So when we look at the spot VIX, there's no instrument that directly tracks this or mirrors it. You have futures on the VIX, which the pros trade. I like to trade the futures. And they have near term. You have just like stock futures or natural gas. You can pick. You don't have to do the near month. Most traders will trade the near month, but some will go out farther. And so there's even midterm futures ETFs out there. I think it's VIXM or something. You can look them up. But these are the short-term futures, and so it's or you can buy options on those futures. So 3 options trade. You can do the VIX futures, options on those futures, and again you have different month futures, options on each of those months at different strike prices, and then you have various ETFs and ETNs that track them. Just like my reply yesterday to someone about using BOIL in lieu of UNG, where really it's not, again, I don't make recommendations. I can't make personal recommendations. These are general recommendations that stay away. You don't need it. Natural gas is probably the most, if not certainly one of the most volatile commodities out there, period. I've seen it go up 15, 20% in a day, and then I've seen it do it again the following day. Very few commodities can do that. You don't need leverage on that. And I've seen the VIX go up much more than that in a day, and I've seen it go up a lot more than that the following day. So my point is, there's no reason. You don't need, you're going to have decay unless you really catch one of those unidirectional rips where the VIX is going up every day. You really just don't need that leverage, guys. It's probably going to work against you. So this is a non-leveraged VIXY. That's why I picked that one as a kind of a proxy for those of you that don't trade futures. Since I've been talking, I just had an alert right now. You might have heard the little buzz going off. This XRT has now cracked that trend line that I tweaked in the beginning of the video. So there's that. I still very much, and I haven't given up on liking stocks as a short, even give you targets, still an official trade. Needs to take out S1 zone right there. And like I said, until they kill the 5-star general, which is NVIDIA, or when they kill the 5-star general more, then that's when this thing's going to start rocking and rolling, because there's a lot of semis that have long since peaked. NVIDIA is just kind of doing its own thing with a couple of the other big ones kind of up there, like Broadcom and some others following it, but they're all starting to break down. I've covered these charts with you recently. There's Broadcom, beautiful little breakdown of this uptrend line / wedge or channel, more of a price channel with a divergent high breakdown. It's been back testing from below. And I often say this, it's not the back. You can make a case to objectively short a back test of a trend line. But what I really like to see is an impulsive rejection finally, whether it's the first day that you back test or a month later, doesn't matter. That's usually the kiss of death right there that says, all right, we've been back testing, but the bulls failed to recover and take back that trend line. Bears won. We'll see. The day is young, guys. If this candle is it's red right now, my candles are set to color by the close of the day. If we close up here and we have a green candle, and we could even get back in the trend line. But I don't know. I think this market's been a powder keg just waiting for a catalyst, someone to just light the match. So could go the other way if they decide to dump it into the close today. All right, that's it. You're just seeing me rifle through the components of SOXX. That's what I'm doing here. So as you see that, if I don't say it, you can see my trend lines where they're at. This one's support level right there. TSM, Taiwan Semi, ASML. A lot of these have these little near-term uptrend lines. They've been walking up. Some of them are cracking. Some of them, AMD's on, AMD already broke down. There's a beautiful, well-defined uptrend line breakdown, but it's been dancing on its first support/price target. So it needs to take that out, and then it goes down here. Comes down probably to the bottom of the gap. It's my opinion. 147.30. Always cover a little bit below the actual support level you're targeting. That's another 9% drop if so, but support is support until unless broken. So as I go through these, this is what I do every day. Like right now, to make a decision, do I want to add to the semis? Well, I'd like to see a little more. Today could just be an early morning bout of selling and they come in and gobble it back up by the close. But as we head into the afternoon, if more and more of these, like Texas Instruments, I see these break down these support levels that we're testing right now, these near-term uptrend lines, that's going to most likely give me a higher degree of confidence that these breakdowns will stick. There's Lam Research breakdown candle today. Applied Materials already long since rolled over. Micron walking on the uptrend line right now, no sell signal yet. ADI just coming off a divergent high, one of the healthier looking, well, it was, but big negative divergence tells me that breakout's likely to fail. And then when it does, that's the thing. So you see, let's see if I roll back. Okay, let me go back here. So you had two all-time or multi-year highs there. Very, very well pronounced. Got rejected big time. Tried it again, got rejected, recently broke out. That's bullish, right? Yay, yay. Yeah, if we all see things different. Bulls see the glass half full, see a breakout to new all-time highs, especially after several attempts. They pile in, but if it fails, that's one of the most bearish things out there in investing is a failed breakout. Why? Two reasons. Number one, breakouts on face value are bullish to new highs. Why is that? Because every single investor in the stock, especially investors, even traders, once something breaks out to new all-time highs, everybody's profitable. There's not a single, at that moment, not a single remorseful holder of the stock that's just dying to get out like they are at 52-week lows, right? Or new lows. And so that in itself is bullish because you have a fresh hand, again, of people that don't have any losses. They're profitable. And the other thing that happens is because of that, we know that a lot of traders will step in alongside traders, which are 95% of your plus percent of the people in the market only buy, they don't go short. And so they step in and buy. And then you also have the shorts that say, oh, well, my reason I was shorting resistance, it worked so well before, but this is where my stop is. So they get stopped out. And then you don't have that short interest. I'm not saying every single one. I'm not speaking literally, but a lot of them will stop out. So now your short interest drops, which leads the way for a bigger drop because you don't have those shorts who are the only guaranteed buyers of stock. They tend to cover. So that's what you want on a stock. You want to blow those weak-handed, I call them weak-handed shorts. You know me, I like to put my stops out of range. If I didn't have a position in ADI, but if I did, it wouldn't be right above the breakout. It would be, you'd have to give it a little room for that failed breakout to occur. And then so that happens. So you have two things. You have the longs that took the breakout. Their stops are right here, here, here. They start to get stopped out. Their stops are actually sell orders. Remember, when you think of it, always put everything in the framing of buying and selling. And this is what makes stocks go up, supply and demand. Yes, you have corporate buybacks. I'm going to talk on that, and then we'll wrap this video up. But you have, sellers. So if a long side, somebody holding a stock gets stopped out, they're selling. And then you also have the shorts come back. They smell blood in the water. Flexible traders like me that see a false breakout with a divergent high that's likely to mean the stock's going to go much lower. They will then step in and start selling, which is additional shorting, which is selling, additional selling pressure. All right, let me move on. Let me get this video out. Let me just give you the where is it? All right, there's that SMCI trade I got out to you. Somebody asked about stock buybacks. Very good question, valid question. Is a stock buyback a big factor for why the market keeps going up? I heard it reaches record high. Your thoughts? Oh, absolutely. I mean, it's a given. Again, that's not something that's debatable or subjective. It's a known fact. And so here's my reply. So yeah, 100% stock buybacks are net bullish contributing factor. And I put the word net bullish because there's a lot there. You can go into the nitty gritty and see that stock buybacks have been accounting for an increasingly and disproportionate share of the buying in the market. So fewer and fewer individuals have been buying. But again, that's a whole nother conversation for itself. So it's a net bullish factor. Now, the bigger picture regarding the trend in the stock market is all about liquidity. Of course, we know we had what I call the nuclear button was hit when COVID came around with massive fiscal and monetary stimulus. That's still sloshing around and eventually will dry up. And then jobs. This is the big one, jobs. So it's a vicious cycle. When the jobless rate is near historic lows, as it has been recently, people will spend money. When people spend money, companies' profits rise. When their profits rise, they plow some of that extra money, found money, if you will, found earnings. Just like when you have a big bonus, if you're a salaried employee or whatever, your sales, you get a big bonus above what you're expecting. That's found money. You go and spend it on something. So the companies will plow that into stock buybacks. Of course, when the employment cycle bottoms and starts to turn, all that happens in reverse. So let me not expand on that. You can do the math, understand how that happens in reverse, including the reduction and or outright cessation of stock buybacks, right? Elimination of buybacks. Now, this is a point worth noting because a lot of folks read the news and trade off what they're reading. I say this often. By the time you've read about something in Bloomberg or the Wall Street Journal or on whatever source you're getting it from or on TV, you've heard somebody say, unless it's breaking news, and there are some kind of sudden news events, but 99% of the stuff you're reading has already been priced into the markets. It's old news. It's old news to those in the know, especially. Those that, Apple executives, think about that. And little birdies fly. Insider trading is and has been illegal for as long as I can remember, but it is one of the most prevalent things out there. So, when somebody works at Apple or any XYZ company and they know they're about to announce a big stock buyback and everything, their earnings are going to be good, little birdies, their relatives, friends, family, it's going to trickle out there and it's going to get priced into the stock. So just know that. So what you're reading now, it's not breaking news that what I put here, keep in mind that just like today, and this is today, I Googled it, corporate stock buybacks were both rising and had surged to record pace. We're at a record pace for 2025, record high buybacks. And this comes off Google. I know it to be true, but I Googled and confirmed it. We had corporate buybacks were both rising and surged to a record pace leading into the 2007 market top. For those of you who haven't been around that long, that was followed by what was now known as the Great Recession and a over 55% drop in the Nasdaq and S&P. So again, it's trading in the rearview mirror. So yeah, right now, and if that trend continues, and it could, yeah, that's net bullish. And you know what? That trend of rising in record stock buybacks will continue as long as that positive feedback loop, which is record low jobless rates, record corporate earnings. As long as most Americans have a job and they're spending money, corporations are making that money. And the corporations are going to keep plowing it back in. So that's going to continue. But when that goes the other way, it has a very powerful effect because, Apple and all these companies can say they plan to buy X amount of stock. They don't have to buy it. They can change their mind. And then more importantly, going forward, then all of a sudden, maybe they're going to finish this pre-announced buyback program because they already had the money set aside. But they're going to next quarter, next year, you're going to have much, much lower stock buybacks and possibly the elimination of them. And then everything just starts working in reverse. So hence the long-term charts. This is the operative word. The long-term weekly and monthly charts are still signaling to me that the punch bowl is likely to be withdrawn relatively soon. What does relatively soon mean? Randy, you've been saying that for a year. Yes, relative is to the time frame of the charts. You're looking at a monthly and a weekly chart. trend lines and the divergences and the overbought conditions and everything I've showed you are relative to those time frames. Those are divergences that have been building and always in the past, before previous bear markets, go back as far as you want to go back to the 70s if you want. Those divergences and conditions tend to build over years, several years, until and then they ultimately play out, and they always have. So when this whole trend of corporate buybacks and low jobless numbers and positive earnings, when that whole vicious cycle or positive feedback loop starts to go the other way, then again, it's first job market, consumers stop spending, corporate profits go down, buybacks go down, and then things are going the other way. And that's where, if you're wondering where the fundamental catalyst might come from my call for a 50+% drop in the Nasdaq and roughly that in a little less in the S&P, that's it. It's just when the tide turns, everything then you get then the feedback loop going. All right, guys, that's it. So we'll see how the day closes. I'll certainly do an update end of day if we have a hurrah reversal, and I showed you, the SMCI really is the one that stands out today. Is a nice op. If that fails, if NVIDIA, they turn around and gobble NVIDIA up and we get it back well above the trend lines that we broke down today, then, again, I'll leave it up to you. A trading plan is a trading plan. I give you what I think is a very well-placed stop on the new SMCI trade. But again, you do you. If you're not going for a much bigger drop, then you might want a tighter stop, as I covered earlier in the video. Okay, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.